Hello and welcome. Today we'll talk about volume spread analysis. I'll show you how to read the market before it moves, and you'll learn to anticipate where the market is going next, based on simple logic and the power of volume and price. So if you could, like, subscribe to the channel, and stick around for the full video. When using volume spread analysis, you should be looking for two things: whether the price has been validated by the volume, or whether there is a divergence with the price. If the price is validated, then this confirms a continuation of the price behavior. By contrast, if there is a divergence, then this is sending a signal of a potential change. These are the only things we are searching for in the VSA: validation and divergence. Before we begin, I want to recommend you a book I'm currently reading. It's called A Complete Guide to Volume Price Analysis by Anna Colling. I highly recommend this book. Now, let's further discuss validation and divergence. In this example, we have a widespread up candle with small wicks on top and bottom, and the associated volume is well above average, so the volume is validating the price action. Let's assume each candle represents one trading day, which is also my preferred time frame for VSA. In this case, we have a market which is bullish and has risen strongly in the trading session, closing just below the high of the session. If this is a valid move, then we would expect to see the effort required to push the market higher reflected in the volume. Remember, this is also the Wyckoff's third law of effort versus result. It takes effort for the market to rise and also takes effort for the market to fall. So, if there has been a large change in the price in the session, then we expect to see this validated by a well above average volume bar, which we have. Therefore, in this case, the volume validates the price. And from this, we can assume two things. First, that the price move is confirmed and has not been manipulated by the smart money or the market makers. And second, for the time being, the market is bullish, and until we see a divergence signaled, then we can continue to maintain any long position that we may have in the market. Here we have an example of a narrow spread candle formed on low volume. In this case, the price has increased, but only marginally higher, and the spread of the candle is therefore very narrow. The wicks to the top and bottom are once again small. The associated volume is well below average and is once again validating the price action. And the reason is again because of effort and result. In this case, the market has only increased in price by a small amount, and therefore we would expect to see this reflected in the volume, which should also be low. After all, if effort and result validate one another, the effort required to move the market a few points higher, the result, should only warrant a small amount of effort, the volume. So once again, we have a true picture with the volume validating the price. Here we have our first divergence. It's clear we have a widespread up candle, and if we follow Wyckoff's third rule, this result should be matched by an equal amount of effort. What we have instead is a big result from little effort. That's a divergence. For a widespread up candle, we would expect to see a high volume bar, but here we have a low volume bar. If we were in a long position in the market and this appeared, we would immediately start to question what is happening. Why has this divergence appeared? Is this an early warning of a possible trap? This is a pattern which often occurs at the start of trading sessions in equity markets. What is happening here is that the smart money are trying to feel out the sentiment in the market. The market opens. Then the price is pushed higher to test the interest in the market from the buyers. Once again, this is a signal of a potential trap. The move higher is not a genuine move, but a fake move, designed to suck traders into weak positions, and also to take out stops before reversing sharply and moving in the opposite direction. This is why VSA is so powerful. Volume and price together reveal the truth behind market intentions. In this example, we see a narrow spread candle with high volume, which once again is another divergence. As we saw earlier, A small increase in the price, the result, should only require a small increase in volume, the effort. But this is not the case here. The small price increase has been generated by a huge amount of volume, so clearly something is wrong here. There is only one conclusion we can draw. The market is starting to look weak, and this is a typical pattern that starts to develop at the top of a bullish trend or the bottom of a bearish trend. For example, in an established bullish trend, the market opens, starts to rise a little, and the buyers are now starting to take their profits. As these positions are closed out, more eager buyers come in, but the price never rises, as the longs continue to liquidate and take their profits, and the cycle repeats throughout the session. What is actually happening is that the market has reached a price at which further effort doesn't result in higher prices, as each wave of new buyers is met with longs selling out at this level and taking their profits off the table. So there is no sustained move higher in price. In other words, what this combination of price and volume is revealing is weakness in the market. Now, VSA is only a part of the story. You need to use a variety of other techniques to confirm the picture and provide additional validation. The most important of these are support and resistance, or supply or demand areas. This is where the market is pausing before reversing, or it may simply be a pause in a longer-term trend, which will then be validated by our volume analysis. A breakout from one of these regions of consolidation, coupled with volume, is always a strong signal. Trends are equally important. Whenever you see a divergence which sets the alarm bell ringing, the first step is to establish where you are in a trend. For example, are you at a possible bottom, where perhaps the market has been selling off for some time, but is now looking at a major reversal? Or perhaps you are in the middle of a trend, and you are experiencing a minor pullback or a reversal in the longer-term trend. Deciding where you are in a trend is where you bring in some of your other analytical tools, which then help you to confirm the VSA. In judging where you are in a trend and potential reversal points, you will always be looking at support and resistance, candle patterns, individual candles, or trend lines. All of this will help you to identify where you are in the price action on the chart. In this example, we have a bullish trend developing in a rising market. And what is obvious is that rising prices are followed by rising volume. This is exactly what we would expect to see. The first candle forms a narrow spread up candle with low volume, which is fine. The volume validates the price, no divergence here. The second candle then begins to form. The spread of this is wider than the first, and based on Wyckoff's rule, we expect to see greater volume than on the first bar, which is indeed the case. So the uptrend is valid. The volume has validated the price on both candles. By the time the third candle starts to form and closes with a spread which is wider than both the first and the second, we should expect a high volume bar, which reflects Wyckoff's third law of effort versus result. Once again, the price action on the candle has been validated by the volume. The three candles themselves are now validating the price trend. The price over the three bars has moved higher, developed into a trend, and the volume is rising and now validating the trend itself. In this example, we have what appears to be a bullish trend, with the first narrow spread candle formed by relatively low volume. This is fine, as the volume is validating the price and is in agreement. The second candle then forms, and we have a slightly wider spread candle than the first, but with high volume. This appears to be a divergence. With high volume, we would expect to see a widespread candle. Instead, we only have a candle which is marginally wider in price spread than the previous candle. So this is our first sign. The third candle then forms and closes as a widespread candle, but with volume that is lower than on the previous candle. Given the spread of the bar, It should be higher, not lower. Another warning sign. The fourth candle then forms and closes as a very wide price spread, but the volume is even lower. We now have several divergences here. On the second candle, we have a modest spread in price, but high volume. The market should have risen much further given the effort contained in the volume bar. This is signaling potential weakness. During the third candle, the price spread is wider than the previous candle, but the volume is lower. The buying pressure is draining away. Also, we have a market that is rising, but the volume has decreased on this candle. Rising markets should be associated with rising volume and not falling volume. During the fourth candle, we see further confirmation that the volume and price on this trend are no longer in agreement. We have a wide spread up candle and even lower volume than on previous candles in the trend. So the falling volume is confirming that we have a divergence on the trend, as we expect to see rising volume with a rising trend, whereas here we have falling volumes on a rising trend. So what are the conclusions? The problems start with candle 2. Here we have an effort, but with no equivalent result in terms of the associated price action. This is therefore the first sign of a possible weakness. The market is what is known as overbought. The sellers are moving into the market, sensing an opportunity to short the market. This creates a resistance to higher prices, which is then confirmed on the third and fourth candles, where volume is falling away. Smart money have seen this weakness and are starting to sell, preparing for a move lower, but continue to mark prices higher to give the appearance of a market that is still bullish. It is not. This may only be a temporary pause and not a major change in trend, but nevertheless, it's a warning of a potential weakness in the market. The high volume is as a result of an increasing number of buyers closing out their positions and taking their profits, while the remaining buyers don't have sufficient momentum to take the market higher. Smart money are also selling at this level, adding to the volumes. This is the reason why volumes fall on the next two candles, as they continue to mark the market higher, but are no longer involved in the move themselves. They are trapping traders into weak positions. The initial weakness appeared on the candle 2, which was then further confirmed by candles 3 and 4. This is often the sequence of events that unfolds. Initially, we see a divergence that appear using the single candle analysis. We then wait for other candles to appear and analyze them against the initial divergence. In this case, the divergence was confirmed, with prices continuing to rise on falling volumes, and now we have a market which is apparently weak, and confirmed as such. The next step is to move to the final level in our analysis, which is to consider the analysis in the bigger picture of the chart. This will determine whether what we are seeing is a minor pullback or the precursor to a change in trend. If this makes sense, make sure you watch our other VSA tutorial. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.